All right, this is video 5 on stockholders' equity, and I ended the last one with the ex-dividend date, which is not shown here. It's not, from an accounting standpoint, a date that's important to us, but from a finance standpoint, it's very important. It's the date that the stock begins to trade without the dividend. So the example I was using in the last video, the board of directors declares a $1 per share dividend payable to stockholders of record as of April 30th, payable on May 31st. So the stockholders whom the corporation shows owning the stock at the end of business on April 30th are going to receive the dividend. Now, some date, a day or two before that, the stock will begin to trade without the dividend. Now, what that means, let's just say that the ex-dividend date is April 29th. And what that means is that whomever owns the stock at the end of business on April 28th is going to get the dividend, because it takes a couple of days to get everything processed and the ownership records updated. So the market understands that. The market figures out what the date is that the stock will begin to trade without the dividend. And so the market adjusts the price of the stock accordingly. Now, you may be saying, well, why does that affect the value or the market price of the stock? Well, the answer is, if you buy the stock on April 28th, you're getting a share of stock plus a $1 dividend in a month. If you buy the stock on April 29th, you're getting a share of stock, and that's it. So, would you be willing to pay more for a share of stock plus $1 than you would for just a share of stock? Well, the answer is, of course you would. So, generally speaking, the market is going to come up and say, well, receiving $1 in a month is worth, let's say, 98 cents today. So, the stock will usually drop in price by about that present value of $1 in a month on the ex-dividend date. So if the stock was trading at $80 a share on April 28th, it'll probably drop down to about $79 a share on April 29th. That's the ex-dividend date. So again, no accounting entry made there. From an accounting standpoint, it's not even a date that gets mentioned, but it's an important date related to the stock. Now, we can move on down here and see the journal entries. So on the date of payment, there's what happens. We reduce cash and reduce liabilities for the reduction in dividends payable. So we debit dividends payable, credit cash for the amount of the dividend. Now, at year end, remember when we set up the dividends payable account up here, we debited dividends, credited dividends payable. Dividends is a temporary account, and it's a stockholders' equity account. So that debit to dividends reduced stockholders' equity through a contra stockholders' equity account. Now, because dividends is a temporary account at year end, we have to close that account. We close it to retained earnings because, after all, dividends are earnings that are no longer retained within the corporation. So, at year end, what do? We do a closing entry to debit retained earnings, thus reducing retained earnings, and crediting dividends to close it out or zero it out. Okay, let's do a couple of homework problems. So we have mini exercises 11.7 and 11.8. And so we need to move up here. Mini exercise 11, 7, and 8 right there. And there's my cursor. Okay. NetPass Company has 300,000 shares of common stock authorized, 270,000 shares issued, and 100,000 shares of treasury stock. Company's board of directors declares a dividend of $1 per share of common stock. What is the total amount of the dividend that will be paid? So we have 270,000 shares issued, but 100,000 of those shares are in the treasury. So there are 270,000 minus 100,000 are 170,000 shares outstanding. Those are the shares that will be paid the dividend. So the total amount of the dividend will be $170,000. And sorry, I didn't have that done. So there we have the total amount of the dividend, $170,000. Then we come down here and we're going to have to prepare journal entries here. So on May 20th, the board of directors for auction.com declared a cash dividend of 50 cents per share payable to stockholders of record on June 14th. The dividends were paid on July 14th. The company has 500,000 shares of stock outstanding. Closing entries are recorded on July 31st. Prepare all necessary entries for each date. So, first date, May 20th, the board of directors declared the dividend. So that date, we're going to record the dividend and the liability for the dividend. So 500,000 shares, 50 cents per share, that would be $250,000. So on May 20th, we're going to debit dividends, credit dividends payable, right here for the $250,000. Now the next date is the date of record, okay, payable to stockholders of record on June 14th. And I talked about this earlier. There's no entry on that date. So then the next date is the payment date. So to be paid on or paid on July 14th. So that's the payment date. On that date, we debit dividends payable, credit cash for the $250,000. So July 14th, debit dividends payable, credit cash when we pay the dividend. So we have fulfilled that liability there. And then the last date is the year-end close date. So closing entries are recorded on July 31st. So we need to close temporary accounts. Dividends is a temporary account. So we're going to have to credit dividends to zero it out. So we're going to credit dividends for $250,000. That will zero it out and reduce retained earnings, debit retained earnings for that $250,000. All right, that gets us to the end of that problem. Now let's move on to stock dividends and stock splits. Now, a stock dividend is similar to a cash dividend, but instead of giving the owners cash, we give them more stock. So stock dividends break into two types: large stock dividends right down here and small stock dividends. Now, The literature gives a guideline of 20 to 25% as the breaking point between a small stock dividend and a large stock dividend. Any dividend less than the 20 to 25% range is considered a small stock dividend. Anything greater than the 20 to 25% range is considered a large stock dividend. Now, in the literature, it describes that 20 to 25% range as a guideline, not what's called a bright line. Now, a bright line means this is a cutoff. If it's on this side of the cutoff, you do this. If it's on that side of the cutoff, you do that, and there's no judgment applied. With dividends, it's a guideline, not a bright line, meaning a little judgment has to be applied. Now, reality is you almost never see stock dividends in that 20 to 25% range. Most stock dividends are around 10% or less, or 50% or bigger. Now, from an accounting standpoint, there is a significant difference in the way we account for large stock dividends and small stock dividends. Okay, now small stock dividends are recorded at market price. You see that right here, recorded at market value or market price. In other words, they're recorded at whatever price the stock is trading at the time the stock dividend is declared. Now, large stock dividends are accounted for at par. So if our par value on our stock is 1 cent per share and we issue a 50% stock dividend on 10 million shares, then 50% of 10 million gives you 5 million shares times 1 cent per par per share. So 5 million shares times 1 cent is $50,000. You would account for that large stock dividend then at $50,000. Now, small stock dividend is accounted for at fair market value or at current market price. And so let's say the stock has a 1 cent par, but it has a $20 fair market value. So we would account for the small stock dividend at $20 per share. We would credit common stock for the par value and additional paid-in capital for the rest, and we would debit dividends. Now, they talk about it down here somewhere, and I can't find it, but I will point it out when I find it. But stock dividend is sometimes, there is where I wrote it. I knew I'd written it somewhere. I need to just look at what's right in front of me. But a stock dividend is frequently referred to as capitalizing earnings. And what that means is the ultimate effect of what we do with the stock dividend is move money from retained earnings to common stock and possibly additional paid-in capital. Because remember, when we declare that dividend, we debit dividends. And so we're going to close dividends to retained earnings. So when we close dividends, we're going to credit dividends and debit retained earnings. Now, when we declared the dividend, we debited dividends, credited additional paid-in capital in a small stock dividend, and usually we call it common stock distributable. And then when we distribute the stock, we debit common stock distributable and credit common stock. So the net effect is debit dividends, credit common stock, and possibly additional paid-in capital, and then close dividends to retained earnings. So we debit retained earnings, credit dividends. So the ultimate effect is we increase common stock and additional paid-in capital and